Hello, fellow compounders. Don't invest in index funds. Be an active investor. For years, you have heard people like Jack Bogle and Charles Ellis saying to give up picking stocks and just invest passively in indexes like the S&P 500. I'm here to help you reconsider. Invest in individual stocks instead. In this video, I'll give you 6 reasons to be an enterprising or active investor instead of being a passive index investor. Welcome to the Always Be Compounding Club, where we share ideas on how to build, grow, and enjoy wealth. I'm your host, Dennis Chen. I'm a full-time investor and CFA charter holder. Welcome aboard. Let's get started. In a recent SPIVA report from S&P Global, using data from the end of 2021, the S&P 500 outperformed 74% of actively managed funds over the past 5 years. Some people say that if 3 out of 4 professional investors can't beat the index, what chance do you, the individual investor, have? Should you just throw in the towel and buy the index? I say heck no. You should ignore the pundits and be an active investor. Invest in individual stocks. Here are my 6 reasons for being an enterprising or active investor. Reason number 1, your odds of beating the markets are better than the professionals. We know that 1 out of every 4 professionals actually beat the indexes. But you can do better than that because you have the following advantages. A, you're not forced to sell by investor redemptions. You're the investor, so you can control the redemptions or the sales. B, you're not hindered by too much money, meaning that you can buy any size of business, from micro caps to large caps. This means that your hunting ground is much larger than the professionals. Warren Buffett once said that if he only had $1 million to invest instead of the hundreds of billions, he could make 50% return. He guaranteed it. And C, you have an edge over the professionals on things that you know. For example, if you fly Copa Airlines and connect through the Hub of the Americas in Panama, you may have seen the airport expansion. This would lead you to do a little more research and find out about the company's growth potential. These things are things that you get to see before the Wall Street analyst. And D, you're nimbler and can act quicker than the professionals since you make the decisions. Reason number 2, you don't have to settle for average returns. You have the potential to outperform the index. If you bought the index ETF, the most you could get is the index return. Or a little bit worse since you have to pay some fees. But you can earn better returns in the index by doing some research and independent thinking to avoid the losers and picking good businesses. You don't need to own the entire stock market, losers and winners. You could just exclude some of the obvious losers and you'll be better off. Let's illustrate this by drawing an analogy of the stock market being like a roulette board like in Las Vegas. Index investing is like playing all the numbers on an American roulette board and getting paid 40-1 odds instead of the 35-1 odds on a board with 38 numbers. So if you covered all the numbers, the 38 numbers, with $1 a piece, which means $38, you would win on one of those numbers. And you'll get paid $40 and get back the $1 bet on the winning number. So the payout is $41. So you would have a profit of $3 for every $38 invested, which is around an 8% return. That's index investing. You're covering all the bets, all the stocks in the market. If you buy VTI, Vanguard's Total Stock Market Index, you will be buying around 4,000 stocks. So winners and losers, everything goes. But on average, you would earn somewhere between 8 to 10%. Okay? And some years you will lose. On the other hand, active investing is like betting on some of the numbers on the roulette board, not all of them. Let's say you only bet on half of the numbers, the ones that you have a good idea to be winners. And you take the $19, half of 38, and place $1 bets on 19 numbers. Given your superior picking abilities, you win. So your payout would be $41, that's 40 plus a 1, which would give you a 116% return. This is much better than betting on the entire board. So, exaggerated example, but if you select investments well and you have the right temperament to deal with Mr. Market, you can outperform the indexes. It can be done. It takes curiosity, commitment, discipline, and independent thinking. Here are examples of some people that have beat the indexes over time. Bill Miller, Peter Lynch, and of course, Warren Buffett. Warren has beaten the market for over 65 years. Also, by buying individual stocks, it is possible to buy 10 to 100 baggers. Those are stocks that return 10 times to 100 times your investment. Here's an example of a 10 bagger that I bagged in my portfolio. I bought $1,870 worth of Apple stock on October 4th, 2011. And today, August 2nd, 2022, that position is worth $20,531. That is a gain of $18,611, 10 times my initial investment. I encourage you to read the following 3 books. Number 1, 100 to 1 by Thomas Phelps. Number 2, 100 Bagger by Christopher Mayer. And number 3, One Up on Wall Street by Peter Lynch. Reason number 3, you can pick the businesses that you want to own. Businesses that match your values. For example, if you don't like cigarette makers because your grandmother died of cancer, you can exclude them from the buy list. You pick businesses that fit your values. That's something that you can't do when buying an index. When you buy an index, you get everything. Reason number 4, you can be tax efficient. You can time when you'd actually like to pay your capital gain taxes. They are owed when you sell a stock, so you time the sales. Wait, you say, aren't indexes relatively efficient since they have a low turnover rate? Yes, but if an index changes or a component changes, it would automatically have to sell and replace that component, which is beyond your control. While you, as an individual investor and stock picker, have full control of when you sell your stock and pay your capital gains. Reason number 5, it's good education. You get to learn a lot about the businesses that you research and want to own. It keeps your mind engaged, and it's not boring like an index fund. You actually get to activate that mind and read and ask questions and be curious. And reason number 6, it's more profitable than going to gamble in Las Vegas. So there you have it, 6 good reasons to be an enterprising investor. If you agree, please let me know in the comments below. If you don't agree, check out this other video on reasons to be a passive investor. Personally, in my household, we are split between both camps. I'm an enterprising investor. I love to pick stocks. And my wife is a passive index investor. So let me know in the comments below, what kind of investors are you? Enterprising or passive? Or both? Thanks for watching. Remember to always be compounding. See you in the next video. Take care.